Hi, and welcome to SpotGamma's Introduction to Options Trading video. My name is Matt Fox, and along with our lead innovator Brent Kachuba, I am a co-founder of SpotGamma. Here at SpotGamma, our goal is to provide you with unique information around stock movement based on our evaluation of the derivatives markets. SpotGamma is an information-only site, and nothing contained in any of these videos constitutes investment advice. If you're going to be making any investments, please consult a professionally licensed investment advisor before making your independent decisions. During today's discussion, we will cover options, which are a derivative of equities, which we covered in video 1. If you already have a firm grasp on the mechanics around how to trade options, how assignments work, and the concept of leverage, please feel free to move ahead to our next video. Also, while much of this introductory training information is available on other websites, our educational series is aimed at giving you context around the SpotGamma products, and this theme is carried throughout our videos. In terms of a quick review, there are two positions you can take when opening an equity position. The first is to buy a stock. This is when you take a position where you believe the stock will appreciate or increase in value. The second is to short sell a stock. This is when you take a position where you believe the stock will depreciate or decline in value. Importantly, for today's discussion, we are focusing on stocks which trade on listed exchanges. Over 3,500 U.S. listed stocks have options, a form of stock derivative, which trade in relation to the underlying price on their stocks. We will now continue our discussion with a description of these types of options, calls and puts, and how they reflect an investor's interest in a company relative to a traditional stock. An option may seem like a very confusing concept, but simply stated, it is a way to invest in the outcome of a company by trading contracts that mirror the stock. We will now cover the basics of how this works. For the purposes of our discussion and in preparing you for more in-depth discussions around Gamma, we need to review the four main characteristics of options. 1. Options have a multiplier effect which produces leverage. 2. Options cost money to buy, and those who sell options receive the payment. 3. Options have a price at which you can buy or sell the underlying stock, which is known as the strike price. 4. Options have a time value from the date of purchase to when they expire. To take these in order, first, let's discuss leverage. In terms of listed options, one contract is equal to 100 shares of stock. This means that buying options contracts gives you the ability to have outsized returns if you are right. However, if wrong, you can lose the entirety of what you spent buying the contract. This can produce a defined risk metric that is not available in stocks, as your risk is limited to what you spend on the contract. Secondly, let's discuss the cost of the option. The cost of options have long been valued by calculus equations, including the Black-Scholes method. For our purposes here, what you need to know is that the price of a contract is listed as a bid offer on an exchange, just as prices are with stocks. Third, there is a strike price. This is the price at which you can later execute the option and own the stock. For a call option, if the stock is trading below the strike price, then there is little reason one would execute the option and accept the stock at that higher price. If the stock is trading above the strike price, then the holder of the contract may either 1. Convert the option into stock and then sell the stock at the higher price, or 2. Simply sell the option itself. Lastly, the options have a time value. Most options effectively expire at the close of trading on the third Friday of the month. However, importantly, now many stocks and indices trade options that expire either weekly or even a few times each week. The longer the time to expiration, the higher the cost, because it gives you more time for the stock to reach your price target. Next, we will review examples of both calls and put options, further illustrating these four features. Before we transition to these examples, please keep in mind that SpotGamma monitors and analyzes all options for a given stock and factors their movement and assumed movement into our proprietary calculations. In terms of options, there are two types, calls and puts. We will start by describing an example using call options. A call option is the right to buy a stock at a future price up until a future date. Moving into our example here, as with our last discussion on buying a stock in video 1, let's assume that you believe that the new iPhone 12 will be a big success and Apple stock will go up in the next 3 months. If you decide to buy options, you would pull up your broker's website and see a range of strike prices and expirations. In video 3, we will cover ways to select the right option for your trade. However, here, let's assume you choose to buy the $115 March 19, 2021 call option for $4.50. Let's take a minute and break this down by going through the 4 categories we covered on the last slide. First, let's discuss leverage. In this case, you are buying one contract which represents 100 shares. The second important number is the cost. One contract, which represents 100 shares, would cost you $450. Buying 100 shares outright of Apple stock at $115 would cost you $11,500 of outlay. So the option gives you the chance to outlay less money and have a larger return if the stock price rises. The third important factor is the strike price. Here it is $115. You'd either execute the option by converting it into stock if the stock is above $115, and you would not if the stock is below $115 by the time the option expires. The fourth important factor is the time value. Here it is listed as March 19th, the third Friday of March. Between now and then, you will have the right to buy the stock at $115 or to sell the option for its price at any time. So, in the event that the stock increases to $125, you would be able to convert the stock, sell it for the $10 profit minus your $450 cost, results in $5.50 profit per share, times 100 shares is $550 in total profit. This is much larger than the example from video 1 where you bought 10 shares of stock for $1,050 and made $100 in profit. So in summary, buying a call option gives you the ability to make a leveraged return. However, it comes with the risk that you can lose your entire investment. We will now provide a trading example that utilizes puts. Now, we will cover the opposite of a call option, which is a put option. A put option is the right to short sell a stock at a price up until a future date. Said another way, a put option is a bet that the stock will decline in price. So here, assume you believe Apple stock will decline and you buy one Apple $115 March 19, 2021 put for $4.50. Again, let's go through the same 4 categories. First, regarding leverage, we are paying for the right to short sell 100 shares of Apple because we bought one contract. The cost here is the same as with the call option example. Since one contract represents 100 shares and costs $4.50, you are paying $450. Again, the strike price is $115. So if the stock is below $115, you would execute the option at $115 and buy back the stock lower for the profit. Lastly, again, regarding time, the option expires on the same date of March 19, 2021. So in the event that the stock decreases to $105 per share, you would be able to convert the stock, buy it back for $105, giving you $10 in profit, minus your $450 cost, gives you $5.50 of profit per share, times 100 shares is $550 in total profit. So in summary, buying a put option gives you the ability to make a leveraged return to the downside. However, it comes with the risk that you can lose your entire investment. We will now discuss one more topic related to options, selling them. Having covered the basics of options and having provided an example of a call option purchase and put option purchase, we need to address the idea around selling options. Market makers and sophisticated investors often sell options for one of 2 reasons. The first is they believe that the option itself outright will generate a return. This is because they think the stock will not reach the price at which the option is struck. Therefore, the value goes to 0. In other words, in this case, they sell an option to generate income. In the Apple examples, if the other side of the trade is selling you the one contract of Apple $115 call options, dated March 19, 2021, they are hoping the stock stays below $115 and they can collect and keep the $450 that you've paid. The other reason, and the one we care most about at SpotGamma, is to understand the amount of options trading due to people protecting their stock positions, again, called hedging. At SpotGamma, we track all of these volumes and then provide our subscribers with levels where we think buyers and sellers will likely enter the market. Our last topic to cover before we turn you loose on Gamma is the way options trades are executed. When it comes to trading stocks, we described counterparties in video 1, and this is not a very different concept when it comes to trading options. You can trade electronically through your trading platform or through a broker-dealer if it's a larger trade. However, we need to take a moment to explain that the amount of volume trading in the options markets far exceeds the amount of volume trading in the regular equity markets. This dynamic, which has only increased in size and disproportion over the last few years, gives even more confidence to SpotGamma that our methods for analyzing options volume has important implications for the way that stocks trade. SpotGamma takes all of these trades into consideration and provides its users with levels where we believe all buyers and sellers will trade. There's been a lot to digest in a nearly 10-minute video. We have covered call and put options, the concepts around hedging, and how we apply our knowledge here at SpotGamma. Please do rewatch if helpful and consult other resources that may also be helpful to you as you learn about the markets. The good news is now that we have covered the basics, you are ready to progress to our third video where we start a deeper dive into the world of Gamma. Thank you for your time and interest in SpotGamma, and we hope you join our community along with the thousands of others who get our unique daily insights.